Monday, we talked about what are financial investment securities generally, and we studied the brokerages of the securities firm, especially how they receive the orders from the investors and how they deal with them, how they treat them. So depending on the types of the orders, it could be limit orders or it could be market orders, and that will affect how you settle your transactions. So the limit orders will not be triggered as soon as possible. It may take some time, but it specifies the prices, so it is more you will get accurate results. But on the other hand, in the market order, when you receive a market order, when you give the market orders, it does not specify the prices, but it follows the current situation in the market, so it will be quickly settled. However, the finalized price can be totally different from what you have imagined before you make the orders. So you should also need to look at these examples carefully for to prepare for the midterm. By the way, I need to talk about that. So uh, as written in the syllabus, the midterm exam is scheduled on April 23. This and here April 21, Monday, is a reading period, which means I'm not going to check the attendance, and actually you don't have to come to the class, but you can ask me questions if you want by visiting my office. And also on April 16, just 1 week before the midterm, in this session we are going to have a quiz which will not affect your final grade. However, this quiz will contain some of the problems significantly related to your midterm exam. So I hope you to try these problems during the session and after the class, so that you can get a higher scores from your midterm exam. So actually we only have today, the next week, 1, 2, 3, and 4 classes before the midterm exam. So we don't have much time left. And by the way, we are going to have a group activity on the next Monday regarding the investment companies, in other words, the mutual funds. So actually, we don't have enough time. So I strongly recommend you to start preparing for your midterm exam. Okay, so these examples here, it is important to note that the orders that you receive, the orders of the sequences of the orders that you get, whether you first get the market order or the limit order, it will totally change the final outcomes, because market orders and limit orders, they are settled in very different ways. So you need to understand this from this example. Okay, and let me continue. This is not that important, so let me skip this. Okay, so the next one is about a typical organizational structure of a securities company. So, securities company has a relatively complicated structure because it needs to operate in many different ways. So here there will be a CEO, the Chief Executive Officer. This is the head of this company, and the board of directors exists to supervise and monitor and check the CEOs whether he is doing well or not. And the audit company will help the board of directors to read the accounting documents so that they can identify if there is a fraud undergoing. And also there are several divisions here. uh, so first let me start with the sales division. So the titles of these divisions can vary depending on the particular securities firm, but generally in many of Korean companies they have the similar terms to name the entitle their divisions. So here the sales division, this is the division or the branch to uh, brokerage activities. So this is for the company to receive the customers' transactions and to settle their request. And obviously, there could be two different types of customers. So first, there could be a corporate customers, and there could be individual customers. So generally, they are also separated. And here you have another division, proprietary trading division. So this is about dealing. So dealing is trading the financial investment securities by using their own money. So this is the part where the securities company's own money will be used to buy and sell the securities in the financial market. So generally, these two divisions operate in the secondary market of the capital markets. Among the primary markets and the secondary market, they operate in the secondary market. And we have another separate entity or a division, research center. This is where analysts work. So the financial analysts are belong to the research center, and they do some research about the financial market, and they provide the investors with a suggestion about how to move. For example, whether investors should buy this stock or not. So this will be another division. And there is another division, corporate finance division. So this is the place where underwriting will be covered. So during your group activities, we had a simulation about the underwritings, and that division is for that activity. So here, generally, the counterparty, the customer, is a corporation. But the difference between this and that is that here in this part, the corporate customers are coming to the securities company to buy or sell the existing securities. But here, corporate finance division, they come to the securities firm to make out a new securities. Okay, so we are going to talk about this underwriting and corporate finance activities when we talk about the investment banks soon. And the management support division, this is also referred as a back office, because the front offices are the offices that treat the customers, but back office is for the other a lot of usual things in order to ensure that the security firm will smoothly operate. For example, their own accounting, their own financial decision making, about the human resources. These will be covered in this division. And we have two different separated entity here. So risk management team and the compliance team. So let me talk about why they exist. So if you look at the divisions here, there are several divisions, and you can understand that a single securities company engage in multiple activities, then there could be some problems, especially related to the conflicts of interest. So the securities firm can participate in a lot of activities together. On here, they have brokerages, on there, they have underwritings, and this can create some kind of synergies because although these activities are slightly different from each other, the one thing is true that all of these activities are related to the financial market. So by covering these activities together, they obtained valuable information to do better, and also it will increase their efficiency. However, the problem is that there are certain conflicts of interest because the customers are different. So, for example, one very which often happens in reality is there is a conflict of interest from an analyst report. So we can see that we have a corporate finance division and research center, and we have proprietary trading division. So the role of an analyst belonging to the research center is to provide a objective, a very accurate financial analysis about stocks. Then maybe one of the analysts is a friend of a trader in this proprietary trading division, and he happens to know that during the lunch they had a discussion, and he found out that at this moment this security company is holding, for example, say Samsung Electronics stock a lot. Then the problem is, then he go back to his office, and he was about to write a research report for Samsung Securities. Then he cannot write it negatively, because if he do so, then the stock prices will crash and it will incur losses for the securities firm. So therefore, he should be very cautious not to mention the limitations of Samsung Electronics, because we are already trading that security. So that is a kind of conflict of interest. And similar thing can happen because we have a corporate finance division. As we have done during the group activity, maybe some underwriters maybe multiple securities company may compete to become the underwriter for a specific corporation, and then you cannot say something bad about the corporation because it is important to get that customer for your corporate finance division. So these are the conflicts of interest, and therefore for the securities company, it is important to have the Chinese wall, so some kind of information barrier among the different divisions. So the information from the corporate finance division should not go to the research center, and the information from the research center should not go to the sales division, or vice versa. So the separation of the information is critical to protect their customers' right. And for that, there exist the compliance teams and the risk management team. So the compliance team's main goal is to make sure that there is no conflict of interest, so that this security company may not result in a legal dispute from the customers. So that is why there are compliance teams as well as the risk management team. So these two group will provide advices to the CEO to make sure that there is a no problem, especially in terms of the uh, legal matters about the activities that will be done in this company. So here, this is an example. So in 2003, many large securities firms, they are also called as investment banks, these were sued and they were fined in the court because of the breaches in the customers' protection. So you can see that the penalty even goes up to $400 million. So this is a significant problem for the securities company. And if they do not follow the compliance team's advisory services, then they may result in a total failure in their entire economic activities. Okay, and then we move on to the second part, investment bank. So although I'm technically separating securities firms and investment banks, actually in most cases they are the same entity, but there is slight nuance differences that when we talk about a small or a relatively small or medium-sized securities firm, we just call them securities firm. But when we refer to a very large institutions, we call them investment banks. And as the securities firm become larger and larger, the brokerage fees are not sufficient to maintain their performance. So generally, they have a tendency toward underwriting activities. So they focus in the underwritings and M&A, advisory services, and other corporate finance activities. This is about Korea. So the Korean government has some goals to promote the investment banking in Korea. So the Capital Markets Act was amended in 2013 after 4 years from its initial enactment, and there the government specifies the roles of the investment banks in Korea, and they introduced some of the benefits. If you become an investment bank, you can also do some premium some activities with more profit, like short-term corporate financing, and also prime brokerages, which means these investment banks can sell hedge funds. So far in Korea, the hedge. So we are going to talk about the hedge funds later in the next chapter, but mutual funds are for consumers, for ordinary people. However, for specialized investors, there are hedge funds, and hedge funds are not allowed to individuals because it contains a lot of risk. So hedge funds charges more premiums. They provide more premium services, and they charges higher fees and commissions. So the sellings of hedge funds are not allowed for ordinary securities firm. However, if you happen to become an investment bank, then you can sell. You can be an intermediary of the hedge funds and the customers. So there are limited number of investment banks in Korea. So there is a kind of category. So one of the first door to become a fully functioning total service financial institutions in Korea, the first door is whether you can be a prime brokers or not. And Shinhan, Merit, Hana, Kium, Samsung Korea Investment, NHKB, and Mirae Asset, 1, 2, 3, 4, 5, 6, 7, 8, 9 companies are allowed to sell the hedge funds in Korea. And any other securities firm cannot sell the hedge funds to the customers. And then the next stage is to be classified as investment banks according to the law in Korea, and only 5 companies are accepted, which are Samsung Securities, Korea Investment, NH Securities, KB Securities, and Mirae Asset. And among these 5 players, only 4 can participate in short-term corporate financing activities, underwriting the corporate papers. So only they are Korea Investment, NHKB, and Mirae Asset. So these 4 players are the largest securities company in Korea, and generally we call them as investment banks in Korea. But one funny thing, one very short story about Samsung is here. So Samsung Securities is also, in terms of their market shares, Samsung Securities is also a large player in the securities market. However, unfortunately, they are not accepted yet. And the problem, the major concern for the government not allowing Samsung Securities is because it is a subsidiary of Samsung Group. And if it allows it, then it is very likely that Samsung Securities will help the other subsidiaries of Samsung Group to issue short-term financing securities, and that will help Samsung Group. And there was a legal issue for the Samsung because until 1 month before, the president of Samsung Group was in charge of guilty that he was trying to succeed his father, his father, and during that process, it was thought that maybe he had a illegal transactions of the securities of Samsung Group. So he was in charge and he was on the court, and that was the major concern for the government. So the government didn't allow Samsung Securities to be a participant in the short-term financing market, and that issue is alleviated at this moment because he was found no guilty 3 weeks ago. So there is a news that Samsung Security is attempting to apply for that during this year 2025. So maybe in the next year I may change the lecture note that Samsung will be in that group. Okay, and let me talk about the underwriting. So underwriting is selling financial instruments such as stocks and the bonds in the primary market. So by the term the primary market, this is their first time to be made and to be sold to the investors. And the underwriter is a term that means a financial institution which is participating as a partner of the issuing company. And the reason that we call them as underwriter is because in the as we have done when we register for the securities, the issuing company will write down everything, and in the end, at the end of the document, the underwriter will also provide some signature confirming that this is true and valid. So it is written under the signature of the issuing company. So that is the reason why we often call them as the underwriters. And sometimes when a issuing company is trying to sell a lot of securities, a very large amount of securities together, then a single underwriter may not be able to sell everything. So in that case, 2 or 3 or more securities firm create a kind of a consortium to participate in that process. So there could be a syndication. In that case, there could be a leader or a representative, and that representative is often called as book runner. The reason that we call it as a book runner is it will, as a representative or a lead arranger, it will allocate the shares among the underwriters. So it will designate how much shares each institution should sell. So in that sense, we call them as a book runner. And underwriting activities is becoming more and more important because as we have seen, the fees, the profit from the brokerage's activities are diminishing. So it is becoming more important to earn more fees and commissions from the underwriting activities. And in most of cases, so you can see that the total underwriting, the profits from the underwriting is increasing as time goes by. And also, and let me explain about the process in a stock issuance. So there could be, when we talk about underwriting in general, it can be a issuance of a bond and it can be an issuance of a stock, but we are going to focus on the stocks in this here because from the perspective of investors, generally what we see is stocks rather than the bonds. And in a single stock issuance, there could be two different types. First, there can be a private placement, which is selling the shares to specified very important individuals only, but not everyone else. That is called as a private because this is not about the public investors. But on the other hand, there can be a public offering, which means selling a lot of shares, a bunch of shares to unspecified, anonymous public investors. So in that case, anyone can join in that process. And especially when this is the first time to offer the shares to the public investors, we call it as an initial public offering, or in short, IPO. And this is the dramatic moment for the company because this is the time where the company reveals its inside information and it becomes tradable in the financial markets. So after that, any investor can buy or sell their shares in the stock market, but before that, it was not possible. So this is the very essence of the corporate finance, and therefore for the company as well as the securities firms and investment bank, the initial public offerings are the most important situation. And by the way, for the public offerings after the IPO, they are called as the seasoned equity offering because the shares are already seasoned, and generally it is considered as a negative signal to the performance of the company. So when a company decides to sell the shares, then it needs to appoint one or more underwriters. So that the first step will be having a partnership. So investment bankers will visit the firm and ask for the permission to become the underwriter. And once the underwriter is determined, then the underwriter or the book runner will discuss with the firm about the types of the securities. It can be a common stock, it can be a preferred stock, for example, and then how many shares to be issued and what should be the price to be sold. And then based on that information, the firms, with the help from the investment bankers, they are going to prepare a prospectus. So here the prospectus means it is not yet determined. So there is a possibility that this document's information can change later, but it contains necessary information from the perspective of investors. So it will distribute, the investment banks will distribute the prospectus to potential buyers of the securities. And meanwhile, they need to register the security to the SEC in the America, or FSS, the Financial Supervisory Service in Korea, to check whether there is a legal problem or not. And the SEC or FSS will review the prospectus as well as the register to find out some fraud or errors in the document. And when the investors, especially at this moment, here these investors who read the prospectus are generally large institutions like Vanguard or some institutions like mutual funds. The fund managers will talk about the stocks to be issued, and they are going to give some commentaries whether they believe that the stock price is too high or it is okay. And also they need to provide some information how many shares that they believe that they can buy when the certain shares are issued. And after there is no problem in legally, and after they receive some comments from the potential buyers, they finalize the register. So it would not be a prospectus anymore, and they are going to receive the subscriptions from the investors. And then after they collect the subscriptions, they are going to distribute, they are going to make a distribution plan for the investors, and finally they are going to receive the money from the investors, and the money will go to the company, the issuing company. And from that moment, the underwriter will receive some fees. So that is a general process or the procedure during a IPO. And in this underwriting process, the major problem is that we investment banks and issuing companies plan to say 25 shares, but eventually they were not able to sell 25 shares. They may sell only 10 shares, they may sell only 15 shares, and the remaining shares, this is a burden. So this is a critical issue. So regarding who will be in charge of that risk or the burden, there are two or more types of the underwriting. First, we have a best effort underwriting, and second, we have a firm commitment underwriting. So these are the two major kinds of underwriting process. But there are also third way, which is Dutch auction, but we are not going to talk about the Dutch auction because this is rare. I'm just going to provide some explanation about the Dutch auction after we talk about the best effort and the firm commitment. So first, there can be a best effort underwriting. A best effort underwriting is an underwriting process where the underwriter becomes a kind of broker or an agent. So the nuance is something like this. As a underwriter, I'm going to do my best, and I will try my best to sell your shares to the investors, but I cannot guarantee anything. So that's the best efforts underwriting's major message. So here, the risk of unsold shares will be burdened on the issuing company. And the unsold shares are just canceled. So the number of shares, the final number of shares can be different from their expectation. And on the contrary, the underwriters are just agents, so they are just going to get the proportional fees from their sales. So let me explain how it works. So say there is a security firm A and issuing company B, and A and B agreed on the IPO in a in a best effort basis. And the offering price is 15,000 Korean won. And here the term offering price means this will be the price that a investor pays. Okay? And underwriting fee is determined as 500 Korean won per share. So this will be given to the securities firm whenever they succeed in selling the shares. And the total number of shares that they planned initially to sell is 2 million shares. And then let me compare between two different scenarios, the outcomes. The first one, successful scenario, every shares are sold to the investors. Unsuccessful scenario, only 1.8 million shares are sold and 200 shares are left. In scenario number 1, in the best case, company B will collect the funds from the investors, and the fund size will be determined by the offering price, 15,000 Korean won. However, they must give the fees to the underwriters. And therefore, for each share the underwriter sells, the company will receive 14,500 Korean won. And because they sold 2 million shares in total, what they get is 29 billion Korean won. Meanwhile, securities firms' profit will be entirely determined by the fees, 500 Korean won, so they get 1 billion Korean won. So investors pay 30 billion Korean won, but among the 30 billion, 29 belongs to company, issuing company, and 1 belongs to the securities firm. There's no problem because they were able to sell all the shares they planned. However, in scenario 2, in an unsuccessful case, situation can be somewhat different. So in that case, the company only raises 26 billion 100 million Korean won, 26.1 billion Korean won, because the money they get for each share sold is the same as 14,500 Korean won. However, because they didn't sell 2 million but they sold 1.8 million, their aggregate capital will be decreased. And in that case, securities firm will not also get the fees about the unsold portion. So their fees are also determined by the shares they were able to sell. But you can see that the deduction, the decrease in the amount of the money they receive is slightly smaller. So they will get 0.9 billion Korean won or 900 million won. So let me compare two scenarios. So which entity is severely damaged by the worst case? That is a issuing company. In two cases, securities firms' performance profits also decreases. However, that is slightly nothing if you compare it to the losses for the issuing company. So, in the best efforts underwriting, the risk is burdened by the issuing companies themselves. On the other hand, securities firms' risks are minimized. So, in this kind of contract, security firms are winner and issuing company is a loser if they fail to sell every shares they initially designed. But on the other hand, there is another way of underwriting, which is firm commitment underwriting. So a firm, here the term firm means this is a robust, this is a strong commitment. So this is a promise, so guarantee. So here in this firm commitment underwriting, the underwriter acts not as an agent, but it is the entity who is in charge and who sells the shares to the investors. So it is the principal. So what they do is that first they buy the entire shares from the issuing company and become the owner temporarily, and then they sell the shares to the investors. So underwriters purchase all the shares from the issuing company, and now they have all shares, and this is their responsibility to sell it and distribute it to the investors. So therefore, there is no concern from the point of view of the issuing company because it already sold everything. It already gave the shares, so that's your concern, not mine. If you fail to sell some of the shares. And then how they earn the profit, they can have huge profits because they set some kind of spread between prices. The price that they get the shares from the issuing company and the price that they sell it to the investor. So that will be the spread, and because sometimes the spreads can be even very large, so underwriters can earn a lot of profit from this activity. So here is the similar situation, but just in a firm commitment basis. So again, the offering price, the final stock price to the investor is the same as 15,000 Korean won, and there is a slight change in the terminology. So in the contract, they do not specify the fee, but they specify how much they are going to pay to the issuing company. And let's just say that this is 14,500 Korean won per share to make it even, and then the same number of shares will be issued. Then let's think about the two scenarios again. So in a successful case, in scenario number 1, nothing changes. Company will raise, they are going to get 14,500 Korean won from the underwriter for every share, and they issued 2 million shares, so they are going to get 29 billion. On the other hand, securities firm will get the spread as their profit, so the difference is 500 Korean won, and they sell all the shares, so they get 1 billion. So seemingly in this case, there's no difference between the firm commitment and the best effort underwriting. However, the critical difference happens in the second scenario. So here in the second scenario, even if the securities company were not able to sell all the shares, still the issuing company will raise exactly the same amount of capital from the investor, because the money is not coming from the investor directly, but it is coming from the underwriter. So they were promised to receive 29 billion Korean won from the underwriter, so they get it. But the security firm, their profits may be different. So they were able to sell only 1.8 million shares. So what they get explicitly is 0.9 billion or 900 million Korean won. But there is another concern for the securities firm, because now they have to deal with the unsold shares. So maybe in the future they have to sell it in the stock market at a even lower prices. So or sometimes maybe the stock price will be bounded to the top, and then maybe they can get some additional profits, but still there is an uncertainty, and nobody likes uncertainty. So that's the problem of the securities firm. So in this case, the winner is the issuing company, because they always get what they were promised. So there is nothing to worry about from their point of view. However, security firms is taking the responsibility. So if it didn't work out, then they are going to be in a trouble. So that's the difference between the firm commitment and the best effort underwriting. And as a result, from the beginning of this contract and negotiation, there is a some kind of tendency. So there is a issuing company, and there is a security company, underwriter, and they need to negotiate about their contract. And what happens is that security firm has more information and they have experience. So because they were in the market for in its 10 years or even more, so they have some gut feelings about the succeeding probability for the issuing company's stock. And there are two cases. Number one, they believe it is likely to be successful. Then they offer the firm commitment underwriting, because it is going to be successful. Then securities firm get the entire shares, and they may rise. They may make it even higher price for the investors, so that will maximize their profits. But they don't have to worry about unsold shares, because if they strongly believe that this issuance will be successful. But on the other hand, if they believe that this is likely to be fail, then they offer the best effort underwriting, because they don't want to take the responsibility for the unsold shares. So what happens is that actually this also provides some kind of signal to the issuing company. So if the security companies suggest the firm commitment, then this means that security firms are strongly believing that this will be very successful, so issuing company will proceed. However, if the security firms are offering the best effort underwriting, that means even the underwriters are not believing that this will be successful, so they are just going back, and they are going to reconsider their issuance, and maybe they are going to postpone or wait for a better time, because they don't see any reason to do it right now, even with a huge risk in the market. So what happens in the United States, in 95% of the IPOs are conducted in firm commitment underwriting. And in that process, there is still some kind of risk, and that risk is burdened by the securities firm. And this is also in line with our principle regarding the why financial institutions exist. So in chapter 1, we learned that financial institutions are existing because some risk should be taken care of, and financial institutions' role is to take the risk to help the other entities. So this is a more better outcomes, that security firms are taking charge of the responsibility. On the other hand, the best efforts on the writings are not done frequently, because if it should happen, then they are just going to cancel it or postpone it. So that's the market outcomes